Good afternoon, everyone. Today we're going to be dealing with the zone moving averages and the three stochastics on top of each other. Now, we did do a basic session before, which is available on video. I want to go a little bit more advanced today and just focus a little bit more about how the stochastic and the moving averages actually talk to each other in the same time frame. It's quite interesting to see. But just quickly as a refresher, I'm just going to create a new chart here. I'm going to do it on the Dow and use the hourly. So just so that everybody understands how we put this together, let's right-click Properties. Just going to put the candlesticks on period separators, unclick Show Grid, and just adjust the colors quickly. So the background is white, foreground is black, bar up is black. Bar down is black, bull candle is green, and bear candle is red. Okay, so we're ready with that. Okay, awesome. That's where we're sitting right now. Now, we're going to put various moving averages on here. And I just want to run through the numbers we're going to use. All these moving averages are going to be simple moving averages. So we're starting, the first one is going to be green. So for us, the short term is always going to be green. We're then going to go to a medium term, which is going to be red. And then we're going to go to our long term, which is going to be blue. And those are the three we focus on most of the time. We're going to have another one, which is going to be orange. And the final one is going to be black. Okay, so all simple moving averages, and here are the numbers. So the first one is going to be 11. Now, the first thing to remember is, where do these numbers come from? Now, markets move in threes. In other words, trend, retracement, trend, or zero ABC. It's those three moves the whole time. And what we want to do is getting the moving averages talking perfectly to an oscillator, which means an oscillator usually oscillates between 0 and 100. We use the stochastic, so it's 0 and 100. So if the market moves in threes, a third of 100 is 33, and a third of that is 11. So 11, 22, 33 become our important numbers. So there's the 22. And I'm just going to do this. The blue, in effect, should be 33 then. And you're going to see later why it is quite important. We don't use 33, we use 50. And then we're going to have the 89 there. So 0 plus 11 is 11, 100 minus 11 is 89. And the final one is 155. So there's the numbers. Now, let's look at definition quickly just to remind ourselves what they all mean. The 11 is going to be short-term support and resistance. And we'll discuss that now. Red, the 22 simple moving average, is going to be medium-term support and resistance. Blue is going to define the trend. So above the 50 moving average, the trend is up. Below the 50 moving average, the trend is down. The 89 there is going to be the medium-term trend, and the black is going to be long-term trend. Okay, so that's what each one of them mean in effect. So what we're suggesting with the market, now we know in the market what normally happens is the market goes and finds a level of resistance, 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 and if it breaks, it usually comes back and finds support at that level. So we're not talking about short-term support or resistance or medium-term support and resistance. We just have a trend line, and we would draw a trend line in the market, whether it's horizontal or vertical, doesn't really matter. And we've identified these levels. And then we break out of consolidations and often trade. But what we often find is it comes back and respects those. So as opposed to having to draw your own lines in effect, what we're doing is using the moving averages to give us those levels of resistance and support in the market. And what happens typically is the market shoots up and it will find resistance and that will become support and off it will go. And if it comes down, it will use that same level for support and resistance and it will do the same thing on the 22 before eventually breaking down. So that's where the support and resistance comes through on the 11 and 22. 50 is trend identification. Above it, the trend is up. Above the 50 and below the 50, the trend is down. Okay, so let's quickly put those into the system. So just quickly moving averages. They're all going to be simple. As I said, there's 50. I'll use that as the first one, which is in blue. Okay, and I'm going to change that just now. Next one is 11. Color is going to be green. Next one is 22. It's going to be red. 89 is going to be orange. And then the final one is the 155. Okay, here we have it. And there's going to be some important things that come through here. So what we want to go back to quickly is just look at the zones and where we want to be at any particular time. So while we're trading above the 11 in effect, we're in what we call zone 1. If we break the green, we move down to the red, we're in zone 2. We break the red, the next level of support is zone 3. Zone 4. Zone 5. I'll explain these in detail now. And then below the black, we're going to be in zone 1. Okay, so let's look at this again. Market trends up. Breaks the blue, so the trend is up. Breaks the medium-term support and resistance. Breaks the green. So that's telling me, based on the longer term, the blue, the medium term, the red, the longer term, the green, the trend is up. And in zone 1, you want to be long. And in effect, you want to stay long while it stays above the 11 simple moving average. You're going to see that just now. Now, a candle close below the 11, break previous candle low, there's a very, very good chance, as you'll see, that we're going down to the 22. And that's why I said you want to stay long while it's above the 11. If it closes below the 11, breaks previous candle low, we know we've got a good chance of it's going to the 22. Why stay long, in effect, is really the argument. Exactly the same thing. If we close below the red, there's a very good chance we're going to the blue. That's our next level of support. So let's look at that now. There's some opportunities here. First of all, if we were long over there and we get a candle close below the 11, we want to get out. We want to take the profit. But the next opportunity is if we know that the market is going from the 11 to the 22, does that not give us an opportunity to go short? And then watch it at the 11. If it breaks, the 22, if it breaks the 22, stay short to the 50. So it gives us the opportunity of knowing when to get out of the long, when we're getting a trend reversal, and using moving averages to find the next levels of support and resistance. Now, around the 50 here, 50 is often defined as the B, or the retracement. So what we will often see here is a bounce off the 50 or around the 50, somewhere there. And if that shoots up and moves back into zone 1, what we in effect got is trend retracement. We're in a trend. Again, you want to be long there. But I'll show you just now about a nice way of getting into that. So that is the option around the 50. If we do close below the 50, break previous candle low, we're going to expect to see the orange, which is the medium term trend. Break of that, we expect to see the 155 there. And then if we close below the 155, in effect, we're in zone 1 again. In other words, you want to be short. Now, we need to be careful here. Just by the fact that it's trading below the black means we want to be short, but it's not typically zone 1. What we have to wait for, because what will happen is as it moves, the green moving average will come below and it'll break all of these. We're only truly in zone 1 when the green moving average is below the 155 as well. Then we want to be short, and we stay short then as long as we are below the 11 moving average, because what will happen then is the red will also start coming down and the blue will start coming down. So everything like folds over each other. So in effect, above all the moving averages, the idea is we want to be long. Below all the moving averages, we want to be short. But we must be trading to be short below the green and to be long above the green. That's very important when we look just at that. So let's have a look at that quickly. And you can see it. It's happened again this morning. Let's just zoom in here. So first of all, let's just look at Monday. Down through the green to the red to the blue, and we hit the orange, bounced off the orange. Up above the blue, green, red. Now this becomes important. Can you see that these moving averages in this period here are not in order? In other words, red is above green and blue. And even here, you've got blue, red, green. They're not in order. Now, as soon as we see it, and you'll see it often on the 5-minute period, as soon as we see that conflict, it tells us we're moving into consolidation because the moving averages are not talking to each other. That is so important. But here you can see yesterday how we broke out above the blue, and can you see the green came above? So now again, we're in zone 1 from here, and look at that move up. This morning came down, broke down through the green, respect to the red. You can see we didn't close below the red. And in this candle here, there, in the last hour, we've moved back into zone 1. And I mean, it's a nice move. You know, that was 40, 50 point move as we moved into zone 1 just now. Okay, so very important as far as that's concerned, these zones. Now, I'm just going to jump down to 5 minutes to give you a better indication of what I'm looking at. And I'm looking at this morning again. So, yeah, you can see. Early this morning, green, red, blue, orange, black. Now, we broke below the black here, but at that time of breaking the black, the green was still above the black. Zone 1 truly is only when the green broke below the black, and there's your zone 1. Stay short as long as it stays below the 11. Closing above the 11, we're expecting it to go to the red, to the blue, got very close to the orange there. Okay, and yeah, it moved below all the moving averages, but the green was not below. The green only moved below down here. There was your zone 1 again. Then up through green, red, turn at the orange. Back into zone 1 for that little move there on 5 minutes, and up through green, red, blue, orange, black. Now, as it moved up through black a little bit earlier, that was not zone 1. Zone 1 only occurred when the green was above, from there. And there's your zone 1, and there's your move of 30 to 40 points. Now, if you're long at the moment, that's fine. But for me, on 5 minutes, if we get a candle close below the 11, break previous candle low, we're going down, red, and then we'll start chasing the other colors as well. What I want to stress again is if we look at this yesterday, and you see in this period of consolidation here, these colors were not talking to each other. They were all over the place. It gives us an indication that we're moving into consolidation when it's a mess. They're not in order. We're sideways. Be careful of that. Okay, so that's the indication it gives. So that's really what we're watching for here. Okay, let's just put that picture into place. Okay, so just to sum up on this little one here, if the moving averages are not in order, we're probably going into consolidation. We're not in zone 1 unless the green is above all of them, or we're not in zone 1 unless the green is below all of them. That's what we want to see there, okay, in all those time frames according to the moving averages. And then we want to use them as targets to trade, or we want to use them for trend identifications. Okay, so that's quite cool as far as that goes. Now, what we want to do now is get the oscillator talking to this. And to do that, we're going to get a stochastic. And the first number is going to be, as far as parameters are concerned, percentage K is going to be 33. So 100 divided by 3. Slowing is going to be 1. Percentage D is going to be 1. We don't want a moving average on top of it. And both colors are going to be navy and navy. Okay, so a dark blue. There we got that one. Then we're going to go open our little golden star. We're going to go click on the plus button to the left of indicators, and we're going to do drag and drop. So with the left mouse, we're going to hold the stochastic down, keep the left mouse down, and we're going to drag it and drop it anywhere on top of the other one. Both these colors are going to be red. And percentage K is going to be 22. Percentage D is 1. Slowing is 1, and we're going to click OK. And there we're going to get the red on top of it. We're going to go drag and drop again. And that's going to change now to the 11. 1, 1. Both those colors are going to be green. And there we are. Okay, so we've got the 3. Now, the important thing that's going to come across now is the 50 level of the stochastic. That is so important. Because the first thing I want you to recognize is when the market moves up through the green moving average there. As the market moves up through the green moving average, your green stochastic is moving up through 50. That's what becomes so important for us. When your green stochastic moves down through 50, it's telling us on the same candle that we're moving from zone 1 into zone 2. Now, we went and found support there, green stochastic down through 50. We've broken the 11 moving average. So 11 is talking to 11. A little bit later, can you see that the red stochastic broke down through 50? Well, that told us we're breaking on the same candle the red moving average, the 22, into zone 3, aiming for the blue. Okay, this is where it becomes important. But now there's a little bit of a mess, because it's clear that the blue, the 50, that we're using there is not going to talk to the stochastic, because in effect, if I went to the blue now, and I changed this to 33, that would talk perfectly. So can you see blue there yesterday went up through the 50? On the same candle, we're breaking the 50 moving average, moving into zone 1. Okay. So what becomes important now is two things. Let's just clear this. So I just need these colors. I'm not going to label them all again. We know what they are. So remember again, green is short term, red is medium term, blue is long term. Same on the stochastics. And yeah, at the bottom, I'll put the stochastic. So all I'm worried about now is the 50 level. Okay. So it's actually the 50 level of the stochastic that's talking to each of these moving averages. So if the market shoots up, here we are. In this example, what's going to happen? And I'm making the assumption right now that that moving average is 33. Okay. What's going to happen in this example is as that breaks up through blue, stochastic is breaking up through blue. Same place, there and there. So the stochastic is breaking up through the 50 level. As the market shoots up through the red, that's breaking up through the 50, talking to that as it breaks up through the 22 moving average. And then as it moves up through the green, doing the same thing. It's talking. Okay, so that's the scenario we have, assuming that the blue moving average is at 33. And that is why we like going long when all three of these move together. It tells us the trend is very strong in every time frame, because what's happening at the same time is you're breaking the 50 moving average, the 33 moving average, you're breaking the 22 moving average, and you're breaking the 11 moving average at the same time. But now, we also use our fibs on top of this, and I just want to put this level in here, 89. We use that the whole time. So as long as all three of these stochastics stay above the 89, typically you want to be long. But logically, the short-term trend is going to change before the long-term one does. So out of these three, doesn't it make sense then that when we get the breakdown of the 89, the green is going to move first and the market is going to come off? So as the market breaks the 11 moving average, telling us you don't want to be long anymore, what's this going to do? It's going to be shooting down through the 50. That is there. So now our next, not challenge, but the next level of support is going to be the 50. Sorry, the 22. So let's hit the 22. So the red will follow later on. And as it breaks the 22 moving average, the 22 stochastic will break down through the 50 level. So as you see that, we know from that point to that point, we were in zone 1. As the red shoots down through the 50, we know we're in zone 2. Okay. And now we're moving into zone 3 over there. Red has moved down through 50. We're moving into zone 3. And what will happen is, let's make the assumption we're going to bounce there. In other words, we go respect that moving average, but we don't break it. That will happen. The blue, the 33, will not break the 50 level. And this is what starts becoming quite cool, because normally what happens is the red and the blue kind of like move together. So as long as the red and the blue are above 50, trend is up. There we are there. But what happened with the green is, as the market moved from the 22 to there, you remember that trigger there took place over there. So as that moved down, doesn't it make sense then that that's going to shoot down as well? And we sit in that scenario. Now, let's make the assumption that the market bounces off the blue moving average and moves back into zone 1. There. As it breaks up through the green moving average on the top screen, that will shoot up there, giving us our trigger to go long. Now let's be careful of this. We do trade, and we've seen it in the previous videos, we trade the separations, the stochastic separation. In other words, blue and red are above 50, telling us the medium-term, long-term trend is up. Green is separated. As that comes in there, we want to go long over there. But to make our chances so much better of success in trading this strategy, be very careful that you're only going to take the trade when we're moving back into zone 1. If you get a separation and it's happening in the middle of the moving averages here somewhere, ignore it. Because if we look at this picture and we go back to it, a move into zone 1, nice trade. Move into zone 1, nice trade. Even this morning, move into zone 1, nice trade. So let's take this as an example. Yeah. This morning, early, we broke the 11. Shot down through 50. Now, can you see that we didn't break the red, touched it over there, but we didn't close below it. So the red held and the blue there. But look what happened. As the stochastic shot up through the 50 there, it's giving us a little bit of an early warning, telling us that you're moving back into zone 1. There's your trigger into the zone 1 you want to belong. This doesn't count, obviously. You can see that it's green, red, blue, it's all over the place. So it's similar to the moving averages when they're not talking to each other, the colors are not in order. It's telling us we're moving sideways, we're in consolidation. So here's a nice example as well. All 3 stochastics up through 50. We moved above all the moving averages, but at this time here, was that zone 1? No, it wasn't. At that time, look where the green was. It only became zone 1 when the green was above all the moving averages. But it gives you that warning. Then we get the sideways mess here, and that tells us we're sideways. So ideally what we want is all 3 stochastics moving up through 50. Trend is up, short-term, medium-term, long-term, on condition we're moving into a zone 1. Let's just take it down to 5 minutes. You often see some nice examples. There we had it this morning. All 3 stochastics up through 50. Green, red, blue. Would I have taken that long? No. Because we're trying to go long in the middle of the moving averages. We only want to take the long in zone 1. There's your zone 1 there. Okay, so it really does keep you out of rubbish trades. I wouldn't have taken all 3 of those there because you got that situation. Same over here, you got that situation. yeah, I wouldn't have taken it because we're trading below the moving averages. But let's look at this one. Okay, so what we've gone is green, red, blue. They're very close to each other. Support on the 89, 3 stochastics shoot down through 50. It's where you can look at it. And your next level of support is the black. Break of black, you're in zone 1, you want to be short. But that's fine, because the trend is down. The fact that blue and red are below the 50 tells us the trend is down anyway. Here's a nice example last night. We've got a separation, agreed. Blue and red stayed above the 50 level on the stochastic. There we got the separation. There it is. And as it broke up through 50, you have to agree with me, we moved into zone 1 there. There's your trade. There it is. Nothing over here. I'd just like to find some examples to the downside as well. That wasn't zone 1. Looks like we've got something here. All 3 stochastics down through 50, move into zone 1, but it would only be there when the green came below. There would be your trade. Okay. So that is in essence what we're going to be looking at going forward. But why am I focusing so much time on this at the moment? I know zone 1s to the top and at the bottom are very, very good. But why don't we put this in context? Now, this tells us very nicely when to get in, zone 1 either side. But how are we not going to know when to get out? Or more importantly, not only when to get out, but when to stay in a trade for longer. We're very focused on our daily high lows, for example, in at 61, out at 89. Or opening range, it doesn't matter which fibs we're using. What I'm trying to suggest here is if we can get the fibs plotted, this should help us stay in a trade for longer. So I'm just going to this day and I'm going to put on just a simple daily high low. And hopefully we get a nice example. Yeah, I did prepare a little bit and I tend to remember this is one. It could be on the Aussie wheel of our period of consolidation. Shape in there between the 61 and 89. Okay, there we are there. So let's see what happened here when we got a trigger. Looking at this one. So yeah, in effect, 3 stochastics up through 50, moved into zone 1 there at the lower end of the consolidation area. Once again, we know if we break into a consolidation area, there's a very good chance you're going to see the other side. There it went, broke, hit first target 77. So in effect, there was a trigger long there. If we just take the daily high basic strategy, hit the 77. So first target came down through first target. For us, stop would have moved to entry. But then when it came and it closed below the green there, we knew it was going to red. Why stay in the trade any longer? Red, blue, orange, black. Didn't move into zone 1, green wasn't below. We get a situation after this now, 3 stochastics up through 50. We wouldn't have taken it because we're in the middle of the moving averages. We only want to take something when it's above or below everything. Came down, consolidated again. There, in effect, 3 stochastics up through 50 again, and look at that there. Triggered on the 61. 3 stochastics up through 50, we're in zone 1, and we got a trigger on daily high low in this case. We would have gone 61 to 89, we would have taken profit. But look at the stochastics, why take profit there? 3 stochastics shooting up, straight up through 50, straight up through 80, still got 60% of the run to go. What I'm trying to suggest is let's try use this to say to ourselves, okay, we've reached the 89. We've reached target. So let's move trading stop up to 77. But as long as it stays above the 11 moving average, we're in zone 1, why not stay long? It went and it bounced, got through the 100, so another trigger lock, hit first target of the 127, and it stopped there. Now, at that point, we could easily have continued to go up to the 161. The point is that as it came inside there, that would have been confirmation, take profit, get out. So I'm hoping that by using these zones, we can, when we're in zone one, whether it's to the top or to the bottom, stay in the trades for longer. Okay. And we'll still use our fibs to give us our targets, but not necessarily getting out at the 89 and putting fixed TPs in. We were clearly still in zone one there. Let's just see what it's doing now. Okay, that was previous day. Let's just take it, move it across to today. That's it. Okay, here's our level of consolidation. It hasn't really given us anything today yet, but we'll check it out. Okay. There was a move into zone one. So there the stochastic started to give us an indication, move into zone one. Off it goes, there it is into zone one. Candle is just closed below the 89, so below the 11 there. 89 level of the daily high low is support there as well. My expectation is we're going down to the red now. Now, as we move down to the green, remember, green stochastic is shot down through 50. I'll have a look at it now, Derek. We'll look at the Aussie now. So what I'm suggesting is if the red shoots down through 50 there, you're breaking the red moving average, you should see the blue. If the blue shoots down through 50, we're going to the orange. Okay, so that's the sequence and the order that we should be expecting there. Now, if the green turns here and shoots up through 50, what does it tell us? Green shoots up through 50 now. We've got a separation, have we not? For the green to shoot up through the 50 there right now, means we have to go and break the green moving average over there. Means we're back in zone one. We want to stay long. Okay, so we're at quite a critical point when it comes to the Dow right now. Okay, let's have a look quickly at Aussie. It's in the 5 minutes. These templates saved. There we are. Okay. Now you're going to notice that the blue's not quite talking, isn't it? Because we're using a 33 here, but the moving average we're using there is a 50. 50 is just a lot more reliable. Blue's bouncing off. You can see we came down through the red. If the red shoots up through the 50, that means we're shooting up through the red moving average. If the green shoots then up through 50, that means we're shooting up through the green moving average. It means then, if that happens, we're back in zone one. You want to stay long as we stay above the green. So now you can see exactly that same thing happened yesterday. Look at that. Down, 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 down. So green, red, blue. We broke all those moving averages in those time frames. Not quite in zone one because the green didn't come below the black. All three of them up. And that's when we moved into zone one there, green above the orange, and that's where you wanted to stay long. There it is. Okay, guys, that's what I've got. I hope this helps and puts a different perspective on it. A little bit more advanced. But what I really wanted to do today is focus on how the stochastics talk to the moving averages when we only want to trade into zone 1, whether it's a long or a short. Okay, so in this particular case on the Aussie, we've broken green, red, blue. We're just breaking orange now. We should go to black.
Yeah, but that means we should actually...
Blue's just crossed down through 50, which means in effect it's crossed the 33, not the 50. If I change this now, you'll see it. I'll change that to 33. See that?
Pat, can we talk on this trade, through that strategy, and see if we should also close this trade in earlier?
So next level of support is 155. If the green then comes below the 155, we're going to want to be short below all of this. Okay, let's just check and see if there's any questions.
Pat, can we just take this also trade on the entry and see if this trade would have worked if we look at
maybe
this?
Just as a quick final, because we're trading that today. We haven't got the volatility. There is our daily high-low. Just insert a shape quickly just between the 61 and 38 to get our consolidation zone. And this long was right. Look at it. The long was right. We just don't have the volatility. In effect, red, green, blue, there, up through 50. Didn't we then move into zone 1 when we took this long? We did. We were in zone 1. We want to be long. What you should know is that when we closed, sorry, I got no sound here. I'll be with you in a sec, Derek. I think it's because I got the TV plugged in at the same time. Just want to quickly discuss that. So up it goes. When it closed below the 11, we're hitting. Okay. So if we get a trigger short now, and we had it this morning as well, but the short was not confirmed this morning with the moving averages. In other words, we had this candle close this morning, break previous candle low, somewhere here we got a trigger. Did we move into zone 1? We were below the black, but the green didn't come below the black to follow through. So we still have to take the trade, but we want to see now what is going to happen after, make us feel good about it. If we get a trigger short here, we're going to be below the black. We have to trade the strategy. But what we want to see is the green follow down, and we want to stay in zone 1. Let me just see at the volume going. Derek, try again, sorry.
Okay, Pat, now what I was asking is on this trade, look, we entered when it was above the green, but we should have stopped much earlier. We should not have around the minus 100.
100%. Now, we must just be a little bit careful there, Derek, you are right, is that sometimes, I'm just looking for example, sometimes what it does is it comes down through the green. I'm just going to try and get an example here. Yeah, here's an example. Okay. Comes down through the green, there, hits the red, and then bounces back into zone 1. Do you see that? And you get that separation there. So remember, red is support. There's no guarantee it's going to the blue until it closes below the red. So if we looked at this here, you are right. We could have got a much earlier exit there. But it is possible then it would have bounced off the red and shot back into zone 1, giving the stochastic separation. So what you're saying is 100% right.
If you just look back about, let's say, an hour on that up run, where it went in below the green and then went up. But if you're looking at your stochastics, they all stayed basically above the 50, and that tells you that we're still in the upward trend.
Correct.
This one was probably a little bit messy because our feed wasn't in sequence, and I think this is where we're having a problem.
Yeah, when your stochastics and your moving averages are not in sequence, you're 100% right.
I think that's where the strategy needs to be changed. Otherwise, I'm happy.
Okay. I'm hoping we're using this, Derek, to stay in a trade longer. That's what I'm hoping for.
I certainly agree with that. All I'm saying is that in that case there, we had a green, red, the blue, orange, and black. This one, the colors didn't line up. So this one, we should have had, like, let's say, a below 50% probability that the trade will work, and probably then make a decision, are we going to go in or not?
Sure. 100%. So there we're getting a trigger short, huh? What do you think based on the moving averages and the stochastic?
For me, no, because the others are busy getting a line up, but they're not there really, not there. This is my view based on just on this. Let's call it this rainbow lines of yours.
Sure. I mean, it's just triggered. I think if I'm 100% correct, let me just get this right. There's a trigger. Okay, there it is. Now, based on this, we got a trigger. I'm not excited about it. Now, if the green moving average was below the black and we were moving into zone 1, I would be very excited about that short. That's for me.
Yeah, that is what I'm also was trying to indicate. That is that the let's call it the rainbow colors of yours aren't in the right sequence. So it will be a very, it won't say it won't work, but also the free stochastics and your 50 stochastic are busy pointing upwards. So it's not to say it can't go down more, but then we would probably need something else that will tell us that that we are going into a stronger downward trend, and maybe the 15 minutes are telling us all that or something like that. I'm not sure.
But let's take this assumption now. There, can you see that blue is crossing up through 50 right now? So in effect, what's happening is we're busy playing with a 33 SMA, close to it. Not quite up through it yet, but blue, red, green shoot up through 50. And we get a trigger long. Then I'm excited because actually the sequence here is right at the moment. Green, red, blue, orange, black. So when we came down through the green, hit the red, hit the blue, hit the orange, hit the black, bounced off, black. That 155 is strong. Eh? You can see that historically. It's a strong level. But if we move back and we get a trigger long there on the 61.8, we will be in zone 1. I want to be long. This at the moment is not zone 1. I hope that helps, guys. I hope I've just brought another kind of like dimension to this stuff. Okay, any other comments or any other questions? Nothing. Okay, awesome. That's it for today. The recording takes an hour or two. As soon as I've got it, I'll post it on the TTH Live group. And hopefully it's going to help a little bit.